one place where I think the media is really steering people wrong is we have seen a ton of headlines about tariffs and tariff fears and tariffs driving the market. I'm not seeing that happen.
Steve Brennan and Joe Calhoun are back for question time for Friday and numbers, numbers, numbers. Joe, we're going to start with you and look at the reports that came in. Tell us good, bad, indifferent.
Here's the only number that mattered this week, 25%. That's the tariff we're going to start putting on automobiles starting Monday, apparently. That's the number that everybody's paying attention to. If you're in the markets, that's the number that mattered. All the other stuff, quite frankly, it didn't mean squat. And you can see that because we didn't get much movement out of the dollar or interest rates this week. And nobody really knows what's going to happen with these tariffs and what the impact is going to be. You're not going to see the impact for a while, by the way. We know that because of some other data that we got this week, which I'll get to in a minute. I'm just going to run through this stuff. There was a lot of data this week, so I'm going to run through things really quickly. We got the Chicago, and remember, just remember, all economic data is backward looking, so it tells us nothing about the future, but it does tell us where we are. Chicago Fed National Activity Index came in at 0.18. Zero is the line that says if you're at zero, you're growing at trend. The 3-month average, which is what we look at, is 0.15 now, so we're a little above trend. We got S&P Purchasing Managers Indexes this week. The manufacturing number dropped from 52.7 to 49.8, so that is in contraction. But services surged again up to 54.3 from 51, and the composite, I think, is 53.5. Still solidly expanding, obviously, but the manufacturing side still struggling. Redbook retail sales year over year change in same-store sales plus 5.6%, quite healthy. Case-Shiller Index, the housing prices, up 0.1% for the month, up 4.7% year over year. That's been moderating and continues to do so. It had been down 3 or 4 months in a row. Now we get a little tick up, but that actually doesn't look too bad. New home sales up 1.8%, but at a 676,000 rate. That's just bleh. It ticked up off the lows here, but that's just pretty bad. The Richmond Fed manufacturing survey, that also went down to a -4 from a +6. Durable goods orders. This is where we see some of what's going on here. Durable goods orders up 0.9, but it was almost all of it was in that big game was in automobiles. This is auto companies ramping up production, bringing in parts before the tariffs hit. They've been stockpiling cars and parts for the last couple of months, and we've seen this in the durable goods orders. So, does it mean anything? I don't know. That's why I say that you're not going to see the impact of the tariffs till probably May. From what I understand, the car companies have stockpiled about 2 months worth of supply in anticipation of these tariffs. So this is March, starting April. So April into May, you probably start to see some impact from these things. Core capital goods in the durable goods orders was down 0.3. That's not a good number. And that's probably due to uncertainty. That's what we've been talking about for a long time. Companies are not going to invest if they don't know what the rules are. We had a GDP report, just a final revision on the fourth quarter, 2.4%. That was as expected. We did get the corporate profits number this time, up plus 5.9%. Certainly not great, but it's not. It's a positive number. That's what it wasn't a positive number the quarter before. So I guess that's moving in the right direction. Jobless claims. We haven't seen anything in jobless claims. 225,000 this week, up from 224 last week. So no movement there. 225,000 is still a very low number. We haven't seen anything really come through because of what's going on with Doge and the layoffs at the federal level. I think a lot of those people haven't filed for unemployment claims simply because there's some confusion about whether they're going to get rehired. We'll see how that goes. By the way, retail and wholesale inventories were also both up this week. That's also an indication of front-running the tariffs. Wholesalers and retailers stocking up prior to the imposition of tariffs. Let's see. Pending home sales up 2% and still down almost 4 year over year. Again, not very good. Housing is still having problems here. Before it was interest rates, and now interest rates have come down. I think there's some other uncertainty. A lot of the uncertainty is really impacting people's desire to go out and spend money. on something like this. On a house is obviously a big commitment when you don't know what the economy is going to do. And I think there's a lot of concern about the economy right now. Kansas City Fed actually did improve a little bit to a -2. It's still negative, but it was better than the -5 last month. And the manufacturing piece went to a +1 from a -13. Now, Kansas City District has a lot of oil production and a lot of things to do with the energy industry. So I'm not sure if that really means all that much. I'm not sure exactly what it means. It's small changes anyway. I don't think it means all that much. This morning, we got the personal income and personal spending. This is a continuation of a trend I find quite interesting, and again, points to this uncertainty. We had a good rise in personal income, up 0.8. Expectations were only up for up 0.4, but spending was only up 0.4 when it's expected to be up 0.5. So another rise in the savings rate. That is perfectly consistent with people being uncertain about the future and worried about the future, worried about future economic growth. They save more. And that kind of, it's one of those self-fulfilling prophecy kind of things, right? They save more, they spend less, and they kind of, if you do that to an extreme, you cause the recession you're trying to avoid. On the inflation side, we did get the PCE numbers this morning, the PCE inflation numbers. That's the Fed's preferred gauge, apparently. Plus 0.3 on the month, 2.5% year over year, and the core was up 0.4 and 2.8% year over year. I don't think that was unsurprising. There's nothing there. What else did we get? Then the last thing we got for the week was consumer sentiment. This is just pretty bad. But I'll get to that in a minute. It is bad, but bad's not bad. Bad can be good. We just got to get bad enough. Consumer sentiment, University of Michigan, 57. It's down from almost 65 last month. The 5-year inflation expectations went to 4.1 from 3.5, and in the 1-year inflation number went to 5. The expectations number was really where you got a big whack. That went from 64 to 52.6. And there's news there too, from a political standpoint. We know obviously Republicans are all in on President Trump, and they're very excited about the future, and they're the only ones because independents and Democrats are not looking so happy. Of course, we knew Democrats would not be happy, but their number on expectations is 28. That's as bad as the Republicans were when Biden was president, and neither one of those outliers means all that much. However, the folks in the middle, the independents, by the way, that's a plurality of our population is independent. The Republican Party, Democratic Party, neither one of them has even close to a plurality. It's independents. That dropped to 52. That is not a good number, and it's down from quite a bit higher. I actually, you know what? Was it 52? Hold on a second. Let me get the number. I think it might have been 50. It's down a lot. Yeah, 50.6. That's down from 65.5 in January and down from 67.8 right before the election. So obviously 68 to 50, basically, that's a big drop. Uh, it is what it is. It's politics. I don't know that it means all that much. Consumer sentiment, just so you know, when consumer sentiment is lousy, it's actually a positive sign for the stock market because things can only get so negative. At least you hope so. I don't know where we are as far on the scale there. Historically, we're very low on expectations and very low on consumer sentiment, but it has been lower in the past, so it could get worse. We'll see where it goes. Anyway, not a great week for data, but it wasn't a bad week either. It just didn't matter. All the attention, as I said, was on the auto tariffs, and that's what sucked up all the investors' attention this week.
So, Steve, I heard Joe use a very highly technical financial term in that. Yeah. So, do you subscribe to the same principle this week?
I absolutely
Yeah.
subscribe to the principle. Every week, I'll sign up for the principle. I wanted to, on Fridays we go and we look on the economic data. We look at what came out. I want to touch on kind of something related. Um, in one place where I think the media is really steering people wrong is we have seen a ton of headlines about tariffs and tariff fears and tariffs driving the market. And tariffs are important. All the economic data we cover is important. I'm not seeing that happen. When I look at my stock charts, Yeah, the S&P's down year to date almost 4%. The equal weighted S&P pretty close to flat, hardly down at all. Where's the damage happening? Well, it seems to be happening around something else we talked about. That seems to be what's really driving the market so far. The Magnificent Seven down almost 15%. And yeah, Tesla's at one point was pretty much cut in half from its peak. It's down about 30. That's kind of the big one. But all of them, with the exception of Facebook slash Meta, are down basically from 10 to 20. I mean, we've seen the market leaders. We've seen where we've talked about the concentration risk. That's where the bleeding's been. That's where the damage has been. Not that tariffs and the economic data aren't important, but when you look at the actually what's moving the market here, it isn't necessarily what you'd get from the headlines. Uh, so we're finally seeing some of that concentration risk have an impact. We've talked about maybe, expectations around artificial intelligence are going to have to get reset. Maybe Tesla won't have these self-driving cars out there replacing human drivers and the robotics division up and spinning as fast as people were hoping. Maybe Amazon won't get a payback on that 100 billion capex they're planning on spending mostly on AI as fast as people were expecting, along with some of these multiples. Now, I mean, the only one that's not really down a whole bunch is Facebook slash Meta. But if you go back a few years, it got cut in half at one point. So,
Steve, why
yeah.
did it get cut in half?
Well, because we're all going to be living in a 3D universe.
How much money did Zuckerberg spend on the metaverse and changing the name of the company to Meta? He
Well,
wasted billions on this stuff. And I said it at the beginning, he's wasting his time here, he's wasting his money because nobody's going to do this because it just doesn't work. I've been reading about virtual reality since 1991 and it still doesn't work. But the point is, it's a parallel, man. It's almost exactly like what's going on with AI right now.
exactly. And as I joke, 100 billion here, 100 billion there, pretty soon you're talking real money. Um, but so I would just point out that, yeah, the economic data is important. That's what we do today. But, don't trust those damn journalists who got English degrees. Um, and even the ones that maybe got economics. I met a few ones. Don't be too damn impressed. They have to have this stuff explained to them. The headlines, I think, are kind of steering you wrong here in terms of what's driving the market. We've been talking about tariffs, uncertainty, concentration risk, the payback on AI, the multiples around some of these stocks. And so far this year, I'd say it's really that concentration risk that's been biting you. And that's kind of the story that's not being told.
Well, that's my old business. Spent 20 plus years in quote unquote journalism. Number one principle, if it bleeds, it leads. So you're going to see the most dramatic thing you can right up front to draw you in. And then the other thing people have to say is, okay, so there's the headline, but who wrote it or what organization did it come from? And
Well,
then
Bob,
set your mind.
Well, Bob, let's also just go to the consumer data. Joe just pointed out what are expectations among Democrats? What is the media almost entirely made of? So it's not entirely surprising that the people with the lowest expectations, who are doing most of the reporting, have zeroed in on their low expectations around the Trump presidency and have connected that to stock movements without really bothering to dig into the data in terms of what's going. And you know, everybody has biases. But and certainly if you tune into, say, Fox News or a conservative outlet, you're going to get a different set of biases. But if you go to the Google's news page, it's probably going to be Democratic Party biases that you're getting, but same deal. But hey, consider those sentiment numbers. Consider how people feel about things, and then look through the lens in terms of the coverage of, who's this person biased towards, and maybe it's affected my coverage.
Well, so I think how you approach it is that highly financial term.
Well, guys, listen, here's what you do. Here's what I do. As you guys know, I read a lot. I spend a big portion of my day reading because you have to be well informed and you got to get input from both sides. The truth is always in the middle. And that's where we aim for. And that's why we watch markets to get our view of this thing, because you get millions and millions of people making independent decisions and you get a result that's probably pretty close to accurate. And so when we look at the markets this week, it's kind of interesting, right? How all this data, how all this tariff stuff, and I'll get to that in a second. The 10-year Treasury note this week moved 4 basis points, 0.04%. Seriously, there's nothing there. Now the dollar is in a short-term downtrend, by the way. I mean, we know that we've been in this short-term downtrend. We hit 112, and now we're down to 104. It's continued a little bit this week. We're talking 20 basis points. It was down 0.2%. But it is moving in that direction. That's something we've been expecting. It is kind of happening now. So that's kind of interesting. It hasn't moved enough yet for us to make a big change, but probably the end of the month, we'll see where things are at the end of the month. We do look at some technical signals. We may be making some minor changes at the end of the month based on that. But anyway, on the tariffs, the market is telling you that the economic impact, if they're where they are right now, is not huge. And if you do I did some back of the envelope math, and you can't figure this stuff out exactly because you don't know all the unintended consequences. We've talked about that, right? I come up with like 50 basis points. Maybe growth goes from 2.5 to 2. It's not a disaster. It's not good. It's moving in the wrong direction. And and you guys know I hate tariffs. I think they're awful policy. But, you got to be realistic about it. Just because I don't like them doesn't mean I can't analyze it. So we have to do that. We have to keep our heads about us and think about and watch the market. What is the market telling you? Market tells you this isn't that big a deal. However, it can be a big deal for individual sectors or individual companies. So you see General Motors down, I don't know, 7-8%, maybe 10 by now this week, because GM is the U.S. automaker that spread out the most among Mexico and Canada and the U.S. Ford, by the way, is not. And I don't know what Ford stock is down this week. I don't think it's not down nearly as much as GM. So when you look at these tariffs, you got to think about the individual companies that you're dealing with. That's where you're going to see a bigger impact and bigger market movements. But Steve's right. Look, this sell-off, this correction is not surprising, and it's exactly where we expected it to come out of these very pricey Mag 7, whatever you want to call it, the top 10 in the S&P 500. That's what's come down. And technology, if you want to, make it that specific. And you look at what's doing well, financials have done well this year. Energy's done pretty well. So, I mean, there are some areas that have done well. And by the way, I think I could be wrong, but I'm pretty sure. Let's just take a look here. I believe that we look at value stocks, they're up on the year. And so let's just take a look at that. Year to date, S&P 500 value, it's up 0.8. I went back to that again, Bob. Kind of what we're getting for the whole quarter and everything. Look, it's interesting to me. What's really interesting to me is you get this correction, which we're not even down 10%. Okay, we were down 10%. We sat there for a cup of coffee. We were not down 10% for very long. We're down 7 or 8. Although I don't know the way we're headed right now, maybe we'll be there today. And for what people that are watching this, I laugh because it's a small move. And by the way, 10% corrections happen like every 18 months. If you can't deal with a 10% correction, you probably shouldn't even be in the market. But 10% correction, we try to avoid as much as we can by positioning the portfolio. What we don't do is we don't do it by raising cash. You can't get in and out of the market and avoid a correction and get back in to catch the bottom. You're not going to do it. Period. End of story. If you do it, it's going to be total luck. And it's 50-50 bet. Now, hell, it's not even 50-50. You got to get two things right. You got to get out at the right time and in at the right time. It's hard, man. So now, if we thought there was a bear market coming, maybe that does warrant some bigger changes. But the way you take care of these things is to avoid buying really expensive, stupid stuff, and you stick with tried and true. Look, what we do is kind of boring, but it works. And we're not going to be when the AI stocks take off last year, we didn't keep up. Sorry, I can't do that. I can't keep up with that and also protect the downside, which is what most people hire us for, is to say, hey, I can live without not getting all the upside, but I can't live with getting all the downside. So we try to play to that. That's what we do. But anyway, Steve's right. look, this is just a correction right now. And sentiment, by the way, is really, really negative. That's actually a positive sign for investors. You need to be thinking about what you're going to buy right now, not what you're going to sell. Now, it could get worse. Don't let me, don't take this to mean you should run out and spend all your money today and build a shopping list and go fulfill it and buy everything on Monday. It's not the way this works. It's not the way investing ever works. It's not all or nothing. Yes, sentiment is very negative. That's a time when you want to be a buyer. You still need to be really selective about what you're doing. Always be selective about what you're doing. Anyway, yeah, this week was the data was meh, and the market reaction was meh. Last couple of days have not been pleasant because of the tariffs. That's a knee-jerk emotional reaction by people, I think. We'll see what it does. We may look this afternoon. Maybe we'll be buying some things. I don't know. We've got some cash on hand. But in general, like I said, like Steve said, it's not what people think it is. Now, having said that, we'll see what happens with these tariffs, man. I got to tell you, President Trump came out last night, or apparently on a call recently with the auto companies, kind of told them, "Don't you raise prices because of these tariffs?" And I'm thinking to myself, "Gosh, this is not the free market Republican Party I grew up with. I don't know where these guys came from." The president telling car companies how they got to price their cars. That's not where we ought to be going, I don't think. It was kind of shocking, to tell you the truth. I just I can't believe it. And it made me think of something, by the way. If you're thinking about tariffs, think about this. Well, first of all, we don't know what the final tally is on these tariffs, because on the auto tariffs, but just think about this. The round number is about $100 billion. Okay, so we just raised taxes by $100 billion. It's not a giant number, which is why the market reaction is not giant, but it's still $100 billion that's coming out of the private economy and going back into the government. Is that good? Again, it's a trade-off, right? Everything is a trade-off. If we impose these tariffs and we cut some other tax by $100 billion, it's not neutral, by the way, because there are distortions with both kinds of taxes. If you cut income taxes have a distortion too. Tariffs have a different distortion. Point is, it's not free. It's not just one for one. So figuring out the impact of these things depends on what the entire policy is, not just one piece of it. And we don't know what the other parts of the policies are going to be. And we don't know what they're going to get through Congress. We don't know, what they're going to be able to do. I did see that that President Trump asked at least Stefanik in New York to go back to the House and not go be the United Nations ambassador. I guess they feel like they need the seats. I'm not sure. I think they were worried about losing that seat. So that's how close it is. That's one of the reasons I've been very concerned about getting the tariffs up front, is that we don't know if they can pass the other stuff on the back end. And so her going back into Congress as a Republican, maybe that does help. So I don't know. Anyway, look, this week was exciting and not.
All right, so I will send you guys off to the weekend with a big and hearty eh.
Yeah.
And hey, if you would like help with your portfolio, let us know. Info@alhambrapartners.com.